Barangaroo Studios, the ausbiz COB is the key stuff you need to know about the day in business and finance.
G'day and welcome to the COB. I'm Andrew Gagan. You can join us on this Monday, and if you like things going up, well, you like what happened on the equity market today. That's where we've finished. In fact, let's take a look at where we're at the CBO 200 there, up almost 0.9%. But as you can see, we just sort of hit that after midday, and we didn't move really from then. But we'll take it because that was a positive. Let's take a look at the sectors that have been moving the markets today, beginning with the banks. With the large banks there obviously doing very well, including NAB and Westpac. Bendigo and Adelaide was also reporting today. Elsewhere, in terms of the retailers, they received a bounce. In fact, the one that's missing from that list is Kogan, which received a big bounce off the back of its result. And the telcos also doing well, led by Aussie Broadband, which reported up more than 12%. All right, well, let's just catch up with some of those corporate stories that we have seen today. And Bendigo and Adelaide Bank posting almost 10% rise in full year net profit to $545 million. A collapse in the price of lithium has seen producer Pilbara Minerals book a sharp fall in full year profit, down 89% for the year to $257 million. Aussie Broadband has issued a 4-cent dividend to investors as full year revenue jumped 26% to $100 million and profit climbed 21% to $26.5 million. NIB Holdings slumping after reported a 67% increase in full year net profit to $181 million, but warning of what's ahead, some headwinds. And online retailer Kogan paying a final dividend of 7.5 cents to its shareholders after narrowly returning to profitability in the year just gone. All right, let's get across what is moving markets and welcoming Josh Gilbert again from eToro to the COB. Josh, good to catch up with you as we always do on a Monday. What are you making of those results at the moment? Anyone particularly standing out to you?
Yeah, look, I think we've got to be positive about the results. I think if we look at the performance of the ASX over the last 10 to 15 days, it's been really, really positive. I mean, we had a 10-day winning streak last week, only a minor fall on Friday, and then today back in the green again. And I think a lot of that is being supported, of course, by this idea that we're getting closer to those rate cuts. But it has to be looked at that companies are delivering. I think that Aussie Broadband result today was a bit of a standout. That came after they actually fell on that sort of last update that sort of came in May, which was when they were sort of announced they were going to be sort of launching a new service called Buddy. CapEx was going to be sort of rising. That sort of worried the market. But today, reaffirming full year guidance, 35% jump in EBITDA, and actually seeing better than expected results already from their Simbo acquisition as well. So, again, a real positive result there. And again, the Pilbara result, I guess, is probably no real surprise on the surface, but I think shareholders are probably going to be feeling a little bit of pain there. Nonetheless, revenue down 70%. Net income down 89%, no dividend obviously declared, which probably isn't really much of a surprise given that you've got profits down by 90%. And look, I think that the positive with Pilbara is that they're maybe not sort of resting on their laurels. They're not rolling over. They are focused on obviously that long-term growth. They're obviously new acquisition coming through last week. They announced that, obviously looking to sort of move into Latin resources, get a bit of exposure in South America. So there's a slight positive there. But again, I think it's really, really difficult for investors at the moment to try and be bullish short term on lithium, especially when lithium prices are just not sort of finding that bottom, and we're still getting a bit of a slump in EV sales and really not getting those subsidies coming through. And we've still got China, really not coming to the party for the time being. So I think those were the two standouts from today, really.
Josh, what are you making of the performance of the retailers? And I guess we've seen this in the States too. There's perhaps surprising resilience from consumers.
Yeah, look, I think 100%. The resilience is absolutely taking most people by surprise. I think Walmart and sort of Target were a couple of the standouts in recent weeks. Target sort of ending that sales slump. Shares obviously soared after they reported. I think obviously those US retailers now are going to have those tailwinds of this expectation that we're going to potentially get a bit of an outsized cut from the Fed, even hinting at sort of 50 basis points coming in September. Locally, I think that we're just seeing retailers perform better than expected, in this current environment. We were still seeing spending hold up. JB Hi-Fi was a sort of a great representation of that, right at the start of earnings season when sales in the current period were actually better than expected. I think also maybe getting a little bit of tailwind from those tax cuts that sort of came in July. I think that gives consumers that bit of freedom to have that discretionary spend to go out and buy those maybe higher ticket items and to discretionary spend rather than when those budgets are tight and you have allocated that capital elsewhere. When you do get up a bit of cash freed, that is going to be used maybe in areas that you've maybe not thought about spending on when things have been a bit tough. So yeah, absolutely more resilient than expected. And the tailwind of rate cuts is going to be positive in the US and when they do end up arriving here in Australia as well.
Well, yeah, speaking of which, of course, do you feel as though there's a bit of irrational exuberance on markets at the moment, particularly in the wake of what Jerome Powell had to say, or we knew rate cuts essentially were coming? He hasn't said how large they'll be.
I think the positive that we had from Jerome Powell is just how dovish he was. I don't think we expected him to be that dovish and as clear as he was. I think, the markets, as you said, Andrew, expected a cut. We know pretty much that we're going to get a cut in September, but the sort of the tone of his voice and how clear he was that we were going to get a cut and that pivot, was much stronger than I think we expected, and even hinting towards the potential for a 50 basis point cut and sort of comments around the labour market that they don't want to see any further cooling in that labour market. I think that jobs report that we then get now, right at the start of September, is going to be imperative. That's going to give us a really clear picture of maybe whether we're going to get 25 or 50 basis points, because I think inflation, as we know, continues to move in the right direction. We've got PCE data coming this week as well. I think that once again just seals this view that we are going to sort of see a rate cut, and depending on where we get that number is going to give us an idea of 25 or 50. But we're getting closer to that. If we look at that number that's expected this week, it's expected to sort of rise 0.2%. On a 3-month annualized basis, that's going to be close to sort of 2.1%. So therefore, we're only about 0.1% off of the central bank's goal of 2%, which all in all is sort of pretty positive. So I absolutely think that the 50 basis point cut is all that jobs number is going to be sort of, I think, what the market looks towards to really confirm that. But I don't think the market is getting carried away. I think rate cuts are pretty much guaranteed, and they're coming, and we're going to see quite a few of them coming over the next sort of 3 to 6 months.
Hey Josh, just briefly, another big market mover. I'm not talking about macro, I'm talking about the micro in terms of what we're going to get from Nvidia this week. Of course, always high expectations. What's your view?
Yeah, I think this is the sort of the key event for the week in terms of asset prices, especially sort of stocks. We've obviously had most of the Magnificent Seven already report. This is sort of the last name to sort of come through and really ties up earnings season in the US. I think no denying that it is really the standout and has been the standout amongst those 7 stocks over the past year. Its growth is undeniable and has sort of continued to deliver. Shares are still up sort of 160% year to date as well. So, by far one of the best performing stocks, still on the S&P 500 after last year's performance as well. Dominating AI. I think, again, going into this, a couple of question marks. They sort of mentioned recently there may be some delays with their Blackwell chips. Anything like that, I think, really can put stocks on the back foot. We've seen that through earnings season. You've been punished if the market is a little bit disappointed with guidance. So I think that's something to sort of really focus on. But an early look into demand, if we go back to sort of, Meta, if we go back to Google, if we go back to Microsoft, all of them said that they were increasing their capex moving forward into the next quarter, into the sort of next full year. And where is that money going? It's going straight to Nvidia. We know that without a doubt, that Microsoft's capex is going to Nvidia and those other names as well. So for me, I don't think there's any sort of real worry on the demand side for this quarter. It's going to be if there's any question marks moving, looking at that guidance side of things. But look, it is still a stock that is very, very well owned by retail investors, continues to be bought up and is growing at the ranks here at eToro by the sort of the most love. It's going to be closing in soon, no doubt, on the likes of Tesla. But as I say, I think it's going to be the focus of Wall Street this week, without a doubt.
Josh, lots to look forward to. Thanks for joining us, eToro. Enjoy your week.
Thanks, Andrew. Same to you.
All right, let's come back now and catch up with further news on the earnings front. Enterprise advisory consulting and IT services firm Insurer reporting a revenue of $243.4 million for the financial year, up 36% from the previous year. Profits at $9.7 million, that's down 9%. Forecasting revenue of more than $292 million and adjusted earnings of more than $30 million in the next financial year. Let's get some further detail. Chief Executive Stephen Carl joining us now. Stephen, welcome to ausbiz. Thanks for joining us. Just thank you very much. Before we get into the results, tell us a little more. Those unfamiliar with your firm, what do you actually do?
Yeah, so Atura is like an end-to-end IT service provider. So we specialize in digital transformation, AI, providing managed services, and we focus on selected industry segments, things like natural resources, government, education, utilities, and finance. So it's really about helping clients transform their environment, but then provide the ongoing support and management post that.
Well, you've just dropped that key thematic AI. How are you actually playing that? What's your model in terms of leveraging that, if you like?
Yeah, so look, obviously AI has been quite hyped the last few years, really off the back of the generative AI. We've been involved in AI for some time, so more around helping clients, go through their data and use kind of outcomes that specifically help their environment. We also last week, for example, there was a press release put out by a company called Nuix, where our teams that helped them together with NVIDIA and HPE accelerate their ability to do processing and investigation by tenfold against the previous record benchmarks.
Yeah, actually, can you expand a little more on that partnership with Nuix? So as you say, you're looking to accelerate the AI workloads, if you like. You're actually providing that infrastructure and support, eh?
Yeah, that's right. So we've taken the Nuix Neo solution, worked together with HP and NVIDIA, and worked out a way to do it at greater speed. And speed is important in that environment. So if you're going through investigations or and analyzing mass volumes of data, then the time you do that in is really, really important. So our engineers together with their engineers really kind of set a new benchmark for the speed we can do that. Now, why that's important, we can then take that managed solution, that managed Nuix solution, to our client base and to new clients to analyze and process data, significantly quicker than historically.
How's your pipeline looking in terms of some of those partnerships and contracts?
Yeah, pretty good. Obviously, that was just released last week, but no, look, there's massive demand out there, but massive demand actually across the board, more from a digital transformation perspective. So it's not really just about the AI. There's just one tool in the toolkit. It's more about how do I modernize my environment? How do I remove friction out of the client engagement? And how do I simplify my processes and get costs out? So, I think almost every company now is a technology company. They're all focused on how do I deploy that, how to do it effectively. And Atura is really unique in the market because in addition to having the technical capability, we do have that deep industry focus. And of our, around 1,000 staff, 950 plus are here in Australia. So we can work directly with the client in the room and solve those problems for them.
So, Stephen, to your numbers then, as I mentioned, their net profit down about 9%. What's that attributable to?
Yeah, so look, the decrease in the stat numbers, we did some fairly large acquisitions last year. So there were two components, some amortization component and the acquisition costs. When you strip them out, we actually had an underlying growth of about 21% in EBITDA. So we flagged that to the market throughout the year, knowing we had to do that investment in that M&A. So the underlying business is all there. That was kind of one-offs that drove that.
And what's your forecast?
Yeah, so forecast. So we're looking at 20% growth on the top line during the year. So we're focusing about ending year about 292 million for FY25 and an underlying EBITDA of around 30 million. So we're very consistent on our bottom line performance, and we have a strategy internally of investing any overperformance back into the business. We're focused on growth. We've since FY19, we've achieved an average growth of over 30%, and that's really by taking the performance, delivering an underlying result that's consistent to our investors, and taking that overperformance and putting into growth initiatives.
Stephen, great to get the update from Insurer. Thanks so much for joining us.
Thank you.
Well, plenty of companies reporting today. Let's get to our stock of the day, and that was, in fact, Bendigo and Adelaide Bank. Let's hear from Luke Larity from Seneca Financial Solutions and Nathan Somerson-Durham from Deep Data Analytics.
I think Bendigo is going to be investing a bit of money by the sounds of it over the next few years, a bit more than maybe the market was expecting. I think that, coupled with it, probably needed to be a strong big beat to justify the val here. Still looks really expensive to me. I would have said the same thing to you in June, though, and it's up another $1 since then.
But if you're in the region, I think you have to be a bit more skeptical. I think you've got to be careful. If you're in Bendigo or Bank of Queensland, I think you should be moving. Look, all the banks are expensive. Macquarie is even more expensive, technically speaking, but they're going to hold up, right? The government gives you a guarantee. So if you want to keep the banking exposure, I would probably say move to Macquarie, expect to lose money, but it doesn't matter. They'll come back. So you're okay in the longer term. I think the smaller banks, the regional banks, will see much more volatility in a pullback.
So let's get to the market leaders as it stands today on this Monday. And the uranium miners doing very well, led by DPL, Pal and Boss, all on that list, and also amongst them, Chorus and James Hardie. As far as those that are dragged on the broader market, calcium off the back of its results has been absolutely hammered, down around 24%. NIB also a savage reaction from the market in terms of its warnings of some headwinds for the company. Similarly with Endeavour Group, sold off as well. The smaller end of the markets, Premium, having a big bounce off the back of its results. And on the negative side of the ledger, Close the Loop saw its share price come off by a quarter today. To what is happening overnight, look, not a lot of data, US durable goods and the Dallas Fed Manufacturing Index. Really, it's all about what's happening tomorrow. And that, of course, is all about earnings. We do get China industrial profits for July, but on the list, some of the biggest there, BHP, Coles, also get Guzman and Gomez for the first time, and some of the others there. Woodside, a notable one, along with Worley and Johns Ling Group. So let's round out where we finished on the market, just shy of 0.9% higher on the CBO 200. Very much led by the bigger banks with Westpac and NAB up more than 2%. BHP, ahead of its results, finished about 0.5% higher. That is the COB. Join us again tomorrow. Thanks.